Hey, welcome back to the iWealth podcast. Say, Matt, I've been hearing from some clients this conversation about investing, and should they invest on the fundamentals of a company, so their earnings and things like that, and how well they're doing, or technically just because the stock is going up or that sector is going up. You know, through the pandemic, we heard about the COVID stocks like the Peloton stocks or Zoom communications and different things like that.
Everyone was stuck at home, all of that at-home technology stuff going through the roof.
Right. And so do you buy that because a particular stock fundamentally is doing really, really well, like earnings quarter after quarter after quarter, or technically you look at their charts and they start to go up? And and the answer is it depends, which you hear a lot from me, I think, but it just depends on what market cycle that you're in. We've looked at, over the last 25 years, I've looked at all kinds of money managers, and we've used all kinds of money managers. And some of them are buying on fundamentals and some are on technical analysis. And what comes to mind when I've talked to these clients and this topic comes up is there's a couple companies out there that use math. And they take away all the touchy-feely, I feel good, or the pandemic or whatever, and they're only using math to get you in the market and out of the market. And so they have algorithms built, and they're called Quants, and they have algorithms built, and all of a sudden the market goes up and you're in the market, and the market starts to drop and they get you out. The issue that I've seen over years is that when you have big spikes up and down in the market, they're slow to get you in on the up. And they're slow to get you out on the down. And so it might take them, they might have a math algorithm built that, you know, they're going to pull 50% of your money out if the market drops 5%. And if it drops another 3%, they're going to pull 25%. If it drops another 8%, they're going to, you know, they just have this built out. And what I've watched and witnessed is that a lot of times they're just slow because all of a sudden the market's dropping 10% and then it's dropping another 8% and you're not out of the market. And so by the time they get you out, you're not, you know, you've already went down quite a bit. And then on the way up, the same thing, where they're taking that time to put you in. So, you know, market goes up 3%, they're going to put 10% in your portfolio, and they've got this math built. And when I've looked at this long term and I've looked at their returns, for somebody that's scared of the market, it gives them the peace of mind that somebody's going to pull them out when the market's going to go down. What it doesn't do long term is it just doesn't beat the overall market long term.
Doesn't beat like an index of everything where you're just indexing that particular sector.
So I would prefer to have a conversation with somebody about getting the appetite or stomach to be able to have a portfolio that matches their risk, and just let the fundamentals go and let the stock pickers pick those stocks and ride that thing out, and make sure you don't have your emergency money invested that's going to be down 10% tomorrow. But it is really interesting because you know, you hear people all the time that talk on the news and things about, you know, why are they buying this stock or that stock? They have no earnings, they don't make any money. Well, Amazon didn't either for a long time, and look what's gone on with Amazon. So it's just an interesting paradigm.
So just hearing you talk through this, I kind of think in a lot of ways, like the roller coaster thing that we were talking about before, right? If it's a roller coaster and you were to imagine this bot, so to speak, this kind of smoothing out the highs and the lows to it, and it may be less scary to be on, but at the end of it, the ride wasn't as fun and it didn't take you as far as what it really needed to at retirement, so to speak. Right. It's kind of smoothing out the roller coaster. So you have a more tame roller coaster. And
what's interesting, so you use roller coasters and I use sailboats. Or boats, right? And so the sailboat is that index that's going to go up and down when the winds come up and the winds go down, it's going to go up and down. And then somebody in a rowboat that's rowing that boat and choosing when to get in and out. And so we talked about quants, which is the math and the algorithms. I would prefer to have a team of people that are using math but are also fundamentally looking at things to try to smooth out that roller coaster ride in your speak, where it's not the highs and lows, but a little bit more even keel, you know, over time. So
totally interesting.
All kinds of analogies, but a person should be aware that there's different ways to manage money out there. It's not just buy a stock and forget about it. There's different
and that's why it's
teams.
Such a big deal of who you're picking to kind of quarterback that, so to speak. For you and to interpret some of that information as to how your money as an investor is really being used.
So, you bet.
Cool. All right. Well, we will see you back here next time. If you guys have any questions about this, make sure to drop it in the comments below, and we will take that little podcast on at some time in the future.
You bet. Thanks, Matt.
Later.